All right, guys. 3M is down 10% year to date, but up 5.5% right now. They just reported earnings before the opening bell. Mo, what happened?
Earnings per share estimate was $1.73. It came in at $2.17.
They crushed it by 25%. Okay, next.
On the revenue side, $7.88 billion was the estimate, and they reported $7.99 billion.
All right, so they beat on both earnings and revenue. And guys, there's a lot of talk about these lawsuits. They just settled a $10 billion lawsuit that's going to be paid out over many years. But there's still this earbud.
Yes.
This ear, what's it called?
It's basically with the
earplug
defense,
with the military. And there's like 300,000 defendants, plaintiffs in it, and it's a big lawsuit. 200,000 cases. Yeah. It's a lot. So
it's a lot, and the $10 billion one, $10.3 billion, is paid out over 13 years. So remember that when you're thinking of cash flow.
Yeah. So guys, these are two lingering things, and the market doesn't like things standing out there. So when they announced this $10.3 billion settlement, the stock went up. Unknowns are scary to the market.
Right.
Now, your goal and our goal as investors is to sit there and say, when is the market overreacting? So in this video, we're going to go over the earnings release. We're going to go over the 8-pillar process, analyst estimates. We're going to do our stock analyzer tool. There's something in this video for beginners all the way to more advanced investors. So stay all the way through so we can show you our thought process. This is done completely off the cuff. We do zero scripting. So when you hear us talking, it is literally as we go along, because our goal, not to over inundate ourselves with a lot of data. We want to sit there and stick to what fundamentally matters in a business. And a lot of people will sit there and say, no, you got to know the nitty gritty. We don't believe so. We think you can be a successful investor by staying higher level. Now, we do believe in understanding multiples and things like that, but it's been proven time and time again that stay focused on a general business. 3M's a very large company, so let's take a look at some high levels of 3M to start. So our market cap is $60.44 billion. That means if you bought every share on the market outstanding at the current market price, that's what you're going to pay. And there's some debt in the company because the enterprise value is $88 billion. That involves buying all the shares, plus all their debt. So if you want to have the company with no debt, nothing in the bank account, that's what you have to pay. All right, now look at this PE, Mo. It's 11. Look at the 5-year PE, also 11. But look at this dividend, 5.5%. Now, here's an unpopular take.
Unpopular take and written about take on Seeking Alpha.
Oh, somebody did write about that?
Yeah.
They should not be paying this dividend. This stock is so cheap. They should be buying back. They should cut this dividend to zero and buy back a ton of shares. Every year they'd be buying back, saving this dividend, they'd be buying back 5% of the company. Why is that a good thing? Mo, why is it a good thing for them to buy back the shares?
Because as a shareholder, then you own a bigger chunk of the pie.
Exactly. So as they buy back more and more shares, you're sitting there with your same number of shares, and as they buy back those shares, the market cap stays the same, but now you're getting a bigger and bigger piece of the company.
Yes.
Your 1 share out of 10 goes from 10%, and they buy back 2 shares as 1 share out of 8. It's now 12.3% of the company. Right. And they take it down to 5, it's 20% of the business. Right. Just by you sitting there and enjoying it.
So you're not getting that quarterly check. It doesn't look like you're making more money, but you do own a bigger piece of the pie.
Don't fall into the BS out there that a dividend is the ultimate thing because it's money in your pocket. It's going to either be in the bank account of the company in which you own a piece, or it's going to be in your pocket, but you've paid a dividend tax on that after the company has already paid taxes on that profit. That's what people don't realize. They're paying this dividend of $3.34 billion, but guess what? The cash flow they're paying out of it is already after tax. So you're being taxed twice.
Yeah. And to you newer investors, you might look at that and say, well, they're being taxed on it, doesn't affect me. Well, no, you own a piece of the business. It does affect you.
Yeah.
You're paying it twice.
Yeah, you are paying it twice. You've already paid it in some way. Mo, look at this, a 5-year return on invested capital of 14.5%.
I think every time we do this video, I forget, and I'm like, man, that's actually more than I thought.
Full disclosure, I own 3M stock.
Yep.
Do you own 3M stock, Mo?
Not.
I own 3M stock. Do not buy the company just because I own it. That would be an absolutely terrible idea. We're here on this channel to teach a process. Subscribe to us because you want to learn how to find the stocks for yourself. If you just clone investors, if this stock goes to 50, you're not going to understand why you want to buy more shares of it. So again, I own the stock in full disclosure, but Do not copy me at all. That would be a bad idea. We're here to teach a process. I'm here to teach you how to fish. That way you don't have to rely on anybody in the future, and you can make your own independent decisions of every investment you make. Now, the return on invested capital means that the money they reinvest back in the business gets a high rate of return. And that's awesome. It's a great way to increase your profit and revenue at higher rates of return. The market average is 9 or 10%. You want to find companies with a higher return on invested capital so they can grow their profit at much higher rates. Now, let's go check out our wonderful 8 pillars. And for those of you who have our software, remember, you can do custom pillars, up to 12 of them. Mo has 4. I stick with our original 8 because I'm basically the one that came up with them. But X's on net income being down over 5 years and cash flow being down over 5 years. Whoa, Mo. Look at that cash flow drop.
I was just on the cash flow statement looking at it.
So what's the so guys, look, net income's down 184 million in the last 5 years. Cash flow though is down 1.63 billion. Okay.
So I will say, if you look at the last decade, they've been between 4 and 5.5 billion, and 2021 was 7.11 billion. It stood out. So now it's back to that. It was 5 billion last year, 4 billion the
But in 2019, it was 5.7 billion.
But it was 4 billion back in 2018. It was 4 billion back in 2014. So I look at this one and say maybe that's throwing everything off.
Yeah. Okay. So guys, remember, when there are fluctuations, a company like 3M doesn't have major growth potential. If we sit here and look at their analyst estimates here, analysts believe revenue is going to grow 2 to 4% a year. It's not much growth here. But 3M is a company that's ingrained in our lives. Okay, so they're going to have very consistent growth. Remember, in fact, you probably prefer the more boring companies because those are the companies that are often overlooked. Mm-hmm. If they're overlooked, it's a great opportunity to find hidden value. Everybody wants to chase the companies growing 10, 15, 20, 30% a year.
These are exciting.
Yeah, they're exciting.
At that moment in time.
But guess what happens? People overpay for a good thing. And everything reverts back to a mean. The bigger and bigger company it is, the harder it is to grow. This company does $32 billion in revenue. This year is the estimate. $32 billion, that's a lot of revenue.
Yes.
Look at the earnings per share though. We have much higher growth than 2 or 3%. So that's good. Just consistent earnings per share growth.
Right.
Now, like I said, if the stock stays cheap, I want them buying back more shares. I don't like the fact they pay that dividend. It is nice to get that dividend. It's 5.5%. Don't get me wrong. And every month, every quarter, I cash it. Don't get me wrong.
So I'm just going to take a stab at this and say things have gotten so bad publicly for them, they don't want to add another layer on top of
You're probably right. Because what's the stock high? Let's go back here. The stock all-time high was 260 5.5 years ago. So they're probably like, damn, we're down to 110 from 260 in 5.5 years. Because look, 5 years, the stock is down 46%. That's the whole point, guys. We want you to remember that we're here to advise on how to buy a company, how to look at a company as a long stream of cash flow. If you understand that process, if you like the stock at 200, you better love it at 110. Now, I didn't look at the stock 5 years ago, so I have no idea if I liked it or not. But again, if you love the stock at 200, when it falls to 110 and all the fundamentals are the same, that's when you buy more shares. All right? So we saw those analyst estimates, Mo, right? Mm-hmm. And based on 2027, it's selling for like less than 10 times its 2027 earnings. But again, what can happen there? A lot can happen in the meantime, but I mean, very consistent free cash flow and earnings, a very low, good profit margin, good gross margin. I mean, Mo, look at this. Their profit margin in the last 5 years, 16.4. Last year, 16.3.
Yeah.
These are very consistent.
Very consistent. That's what you like seeing.
Average 5-year net income, 5.47. Last year, 5.45.
Yeah.
So again, this company is not going to sit there and make you brag like, I've got 3M stock. But at the end of the day, when you buy it cheap, and if it gets cheaper and it can grow, that's where you're going to make your money.
Yeah, I should rephrase. That's what you like seeing in an investment like this. You like seeing that.
Correct.
Something that's kind of a quote unquote dinosaur stock, not going to go anywhere. Consistency.
So anything else in the earnings release that we should pay attention to?
Let me go here. Press release. Let's see. They have raised their full year 2023 outlook from $8.60 to $9.10 from $8.50 to $9.
Okay, so they went about 10 cents higher.
Yeah, 10 cents higher.
Good job.
Adjusted sales growth, they left it the same. It's actually negative 3% to flat. That was kind of what they were predicting earlier this year. Let me see anything super exciting. I think the big thing for them
is the settlements.
The settlements, yeah. And they had one settlement. I don't know if there's a projection for when the earplug one is going to be settled. That one's pretty up in the air.
I think I read that the. Go ahead.
I bet they'll say something on their conference call
100%.
about it.
And guys, the conference call already happened.
Yeah, so you can go and listen to it if you
can go
want to.
listen to it. It's a good way to get an impression of what the management thinks. I believe I read an article recently about how the judge is forcing 3M to show up to this like mediation or something like that. Guys, this is the stuff that I think you pay attention to only because, but remember, if they settle this lawsuit, I imagine the stock might pop. So you've got to be okay buying it when there's uncertainty. That's when you get your best deals. When the news is the worst and the uncertainty is the highest, that's when you get the best deals. The hard part is being able to buy during those times. Is 3M going out of business?
No.
My guess is they're not. My guess is they're not going out of business, right?
And I do think if you look at this public water settlement that they resolved, $10.3 billion over 13 years, I think that's pretty positive if you're looking at they're going to probably push for some type of same structure for their earplug one.
Yeah, probably.
Push it out over a bunch of years.
Yeah.
All right.
Remember, 3M is a very wide-ranging company. They had a lot of products. They have a lot of things. Understand that so you can sit there and focus on that going forward, right? There's a lot of things here. And if they keep the dividend going and the stock only grows 3 or 4% a year, you're still going to get a pretty nice return. So the question becomes, what is a reasonable price to pay for the stock? And that is why we use our stock analyzer tool. This thing has been used over 2 million times since we started it. Over 2 million times by our users. Right here, it allows you to make assumptions about the future. Revenue growth, profit margin, all these assumptions, and it tells you at the end what price to pay. Doesn't include the balance sheet. So all of this, guys, including all of these tools, we're very proud of our software. There's over 10,000 stocks in our software available to you right at your phone or on your computer. We have a phone app, we have a computer, plus all of these tools available for you on your phone and on your computer, all available, running a special. Our typical price is $39 a month. If you sign up now, then you get it for $29 a month. We're doing a $10 off discount right now. It's less than $1 per day. You get all of these tools, including the stock analyzer tool, Everything Money Community, and every update we do in the future to these. All included. This is a no-brainer, guys. It's going to change the way you look at investing. All of the investing tools you need in the palm of your hand. What could be better than that? So, Mo, we're going to do a 10-year analysis. You can do 1 to 20. We're going to do a 10-year analysis on 3M. Give me some revenue growth assumptions for the next 10 years.
I'm going to defer to you on revenue growth.
Really?
Yeah.
Okay, I'm going to do 0, 2, and 4.
Oh, okay.
I think that's low on the 0 side.
I was going to say 0, and I thought you would say you would want to go higher.
I think 4 is high.
Okay.
But anyways, profit margin.
I really would almost just put 16 across the board.
I dig it.
Because I have a hard time splitting hairs of 16 and a quarter.
And what about free cash flow?
I would do the same.
So the only difference is we have that liability coming.
Oh, that's true. Maybe a shade lower, 15%?
Well, so 10.3 billion over 13 years is like 800 million a year or whatever it is. So 800 million on their revenue of 30 billion is 2.5%. So why don't we go 12.5 across the board?
Okay.
So guys, what I did here was we know this pending lawsuit is going to cost them cash flow along the way. I'm just accounting for that here.
Okay.
Because it's the next 10 years, next 13 years, I'm just accounting for that here. They're going to take the profit hit day one. So that's the only thing why I think it's going to be 16% over long periods of time. Now, PE. The current PE is 11, and the current price of free cash flow is 15.
13, 15, and 17? I could also do 12, 14, and 16.
I personally think, now remember, guys, you start at 15, and you go up or down based on return on invested capital, moat, revenue growth. I think 13 is low, personally. I think 15 is the right number, but let's stick with 13, 15, 17. Okay. Let's see how good it looks. Now, guys, our final metric, desired annual return. This is where you put in your margin of safety. The higher your assumptions, the more margin of safety you need, so the higher desired return you need. If this phone is worth $1,000, you make a higher return if you pay $100 for it versus $900. So the higher the return, the lower the price. That's the key here. So we want a higher desired return to drop the price in order to give us margin of safety. So Mo, what would you do for desired annual return for such a big company like this?
I think 10, 12, and 14.
I agree 100%.
And the only reason I went 14 is because 4% revenue growth is very high.
Now, guys, you might be wondering why 10%. I can get 9 or 10% from an ETF, but we've already beaten the company up pretty bad. So we're okay dropping our return requirement because, like, hey, we beat the company up, fine. If we can beat the company up and it hits that, but we still make 10%, we're all happy. So, guys, very key here. Stay with me through the end of this video. There's only a minute or two left. I want to explain the numbers in the Stock Analyzer tool and teach you that process so you become more knowledgeable. Hit the Analyze button. Boom. I got a low price of 81 to 105, a high price of 95 to 122, and a middle price of 88 to 113. If you paid today's price of 110 and the low assumptions occur, you're going to make 5.5%. And this includes the dividend because you can't double count the dividend here. If you get the middle assumptions and today's price, you make 8.6. If the high assumptions occur and you pay today's price 11.8. So what this means is I was buying at sub 100. I was buying at sub 100, and I still think if you want to base it on earnings, okay, you can make some decent money here. But remember, these assumptions are based on cash flow, not based on earnings. So guys, if you like this, again, we're running a special. Instead of $39 a month, it's $29 a month. Go to everythingmoney.com, sign up today. Thank you very much for your time.